This was a week that should teach you something about how markets actually work. Stocks spent the first half terrified of inflation, and the second half looking right past it. They ended the week higher anyway. The path is the whole story. Tuesday, stocks plunged as President Trump teased new strikes on Iran. Wednesday, the inflation report landed, consumer prices at a 3-year high, and the Dow dropped more than 950 points, with the S&P 500 sliding to test its 50-day moving average near 7,230. Then it turned. Thursday, the market ripped higher, small caps up 3%. Friday, the rally extended into the close. The S&P finished the week around 7,449, net higher, after a round trip that whipsawed everyone in between. Underneath all of it was a single variable: Iran. The Strait of Hormuz is one of the most important oil choke points on the planet, and the war had disrupted it. Which is why gasoline was up more than 40% on the year and inflation was running hot. So when the headlines turned, the market turned with them. By Friday, the US and Iran were reportedly close to a peace deal, one that would lift oil sanctions and reopen the strait within 30 days, possibly signed as soon as this weekend. Oil fell, and stocks decided the inflation scare had a shelf life. Here's the part worth slowing down on. The inflation data this week was genuinely hot. Consumer prices up 4.2%, and wholesale prices, the producer side, up 6.5% on the year, the highest since 2022. Normally that combination sinks the market. It didn't, because both reports said the same thing underneath. Strip out energy, and the core was softer than expected. The scary headline was an oil shock, and the oil shock was the thing maybe about to end. The clearest confirmation came Friday, from consumers themselves. The University of Michigan's sentiment index jumped to 48.9, well above expectations, snapping a 4-month slide. And the number inside it that matters most. Inflation expectations actually fell, the 1-year reading down to 4.6%, below what economists expected. When the people getting squeezed at the pump start expecting less inflation, that's the oil shock fading in real time. The same split showed up in individual stocks. SpaceX went public in the largest IPO in history. Shares soared more than 20% on debut. The company raised $75 billion, and on paper, Elon Musk became the world's first trillionaire. On the other end of the mood, software kept getting punished no matter what. Adobe reported record revenue, beat, and raised guidance. And the stock fell about 8%, hit by news its finance chief is leaving for a rival. Oracle did nearly the same thing earlier in the week. Record quarter, sold off. In a market nervous about AI eating into software, good results aren't earning any forgiveness. Next week is the one that counts. The Federal Reserve's 2-day meeting starts Tuesday, with the decision Wednesday. It's first under new chair Kevin Warsh, walking into hot inflation prints on one side and falling inflation expectations on the other. The market spent this week swinging between betting on hikes and betting on cuts. Wednesday, the Fed starts to answer. And the Iran deal, if it actually gets signed, is the variable underneath that answer. So here's what this week actually taught. For 5 days, the market got handed some of the hottest inflation data in years, and rallied. Not because the numbers were good, but because it stopped trading the inflation print and started trading the thing causing it. Where inflation has been is settled. Where it's going runs through the Strait of Hormuz, and for the first time in months, that path might be clearing. We cover the markets on the days that actually matter, with explainers when it helps. Hit subscribe so you don't miss it. We'll see you next time.